Hey everybody, welcome back to Short Verticals. Mike Fairborn sitting in for a good friend and colleague of mine, Connie Hill. I'm joined in the chat by another good friend of mine, Brent Moores. Nice to have him on board. Folks, any questions, comments you have, definitely throw those into the chat. Welcome to you, Paul. We've got Ted, Randy, Bob, how's it going? Will W. Good to have you on board as well as Cedartown folks. Again, any questions, comments you have, definitely throw those in the chat box. Folks, today I do want to take a look at some of maybe using a flag pull, the beginning of a flag, possibly a flag formation as a possible starting point for a short put vertical. We're seeing a few short verticals out there, a few short put vertical possible scenarios that traders could be looking at. One of the situations is many of them are just ahead of earnings. There's an upside to that, obviously a downside. You can have a positive earnings and negative earnings. We'll look at that, but one thing's for sure, many of these have higher implied volatility, which could still stand to benefit us if we are looking at short verticals. More on that in just a second. Let's go ahead and dive on in with some disclosures to get the show on the road, though. Options do carry a high level of risk, are not suitable for all investors. Information here is for general information purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money software applications for education purposes only. Investing does involve risk, including the loss of principal. Finally, here, some key points as it does tie into short options. They can be assigned at any time up to expiration, regardless of the in-the-money amount. An ITM option has a higher risk of being assigned early. Some additional points there listed, as you can see, on Greeks. We'll talk about those momentarily. It will certainly be part of our discussion. Past performance of any security strategy does not guarantee future results or success. And that is what we've got on that front. That should be our last disclosure, and it is. Awesome. Well, welcome everybody that are just joining us now. Robert Boucher, TM. Will, great to have you guys all here. All right. Mike Fairborn again, sitting in for Connie Hill for Short Verticals. I did used to teach a class on short puts and covered calls last year. Now, I do like to always make these comparisons. I was always wanting to have a class where I could talk about the short verticals because there are so many different, I should say positive benefits to them in terms of control, potential, risk control there and being able to potentially control risk. And so I was looking at that and I always like to do this comparison. So I'm going to do that today. We're going to look at a short put and then just add to the short put vertical to kind of show you the differences between the two. But more than anything, folks, it's just going to be taking a look at maybe some opportunities to take advantage of a neutral to bullish type scenario within a given stock that has liquidity characteristics to it. It might have, other components that we could look at. The stock might have a lot of volume, things along those lines. But each one of these companies would be either in the NASDAQ 100 or the S&P 500 to help us with that, basically. All right, so taking a look at the S&P right now, you can see we did get a sharp move on the S&P higher here. And over the last couple of days after that DeepSeek announcement, I'm going to go ahead and just give us a full screen there. And you can see we're just kind of holding into a sideways range in here. What's interesting is we are still up. We did just make a higher high from last week. And if we are positioning ourselves for trades that would tie into, for example, a short put vertical, and we're selling a put down here, -1 put, and we are below that short put, we are +1 put or buying a put, positioning ourselves to stay above that, above those levels. We could have a move to the downside. We could have a move sideways. We could see activity up to options expiration in a sideways range, but we might be holding above our short strike, which is a positive. All else equal, we're looking to collect the maximum gain here. And it's such a cool strategy to be able to sell a couple of put contracts to carry with it that neutral component. I mean, the upside is kind of taken care of. I mean, if we go up, yeah, there's just a much higher likelihood of course, the short options not being assigned before expiration because we're holding above that strike price. Not to say that it can't happen, but yes, it's much, much, much more likely if we hold above that strike price that we will just collect our premium, right, as an income approach. One of the great aspects of the short put vertical is if, in fact, prices, and I'll draw this in red, if we did get a big dip down here, one of the really sweet benefits that separates it completely from just the short put itself. If we just had the short put only, well, we're on the hook dollar for dollar for dollar as the price of the stock is dropping, because there's incredibly likely an assignment that's going to happen of the shares if we are below the strike price by expiration. If we have a short put, I mean, a stock or whatever the case might be can drop. Well, it can drop pretty far. It can drop all the way to zero technically, right? But if you have with it the long put, that would cap our losses to the downside too. So not only does it help us in terms of margin requirement and other aspects, you get that as well. All right, so I had to throw a few things in there just to get us started. I think many of you are very familiar with it, but in case you're not, hey, I just want to throw out a couple of different just points about a short put vertical. One of the key points too is to note over here is that just looking at the markets, because we are looking at bullish to neutral trades today on the short put vertical, we did make that new high that is above this range. And technically, although we don't know if this is going to be the low, that is a higher low here. So there might be a resumption of that upward trend taking place. Okay, so just a quick reference to the market, but let's go ahead and dive in and look at some stocks specifically and make some comparisons here as we look at it. Now, the first company I wanted to look at here is Fast. That is Fastenal. And Fastenal, as you can see here, may have begun to a resumption of a longer term upward trend. I said today I really wanted to start with the pullback of the bull flag as a starting point for a bullish to neutral kind of trade going forward. We got lucky. This is one of those, well, we got lucky in this sense. This is one of those companies we're going to be reviewing that is past earnings. Okay, we're post earnings. It had a good announcement, a good response over earnings. But here's the thing. We had this fairly large pullback. It could, in fact, be just a longer term flag pattern, something that we might actually end up seeing on a weekly chart. Do you guys see what I mean? Flip it to a weekly if you need to see it. Just go over here. I have this set up so I could do that fairly quickly. But there's your weekly. Okay, we see these before in these companies. This is a dividend aristocrat, happens to be, and a lot of these dividend type companies have shown some strength as of late. And sometimes you get the rotation from the market into dividend paying stocks, and they start to look like growth stocks. Now, we don't know if that's going to happen here, but Fastenal still has a longer term upward trend. Now, looking at the weekly chart that I've zoomed in on here, this is the pullback here. These pullbacks are quite long, as you can see, but they can. Let me just do this so I can see it a little bit better from my camera image. Yeah, we pulled back down here and we rallied up, and there was a little bit of a consolidation. And you know what? We might continue to see a same kind of resumption of the trend higher here. We broke this downward trend line. We had a good earnings announcement. These are all indications that we could be looking at to maybe help get us, or I should say, possibly help the stock to hold above a short strike price, which is so important for us to do if we're just going to try to collect that income, right? Three directions, up, sideways, or down to a degree, and we're still trying to collect the max gain there. And so could this be a move to the upside? Just wanted to show you that on a weekly chart first to kind of highlight that for you. But this is the pullback. And we did break up here. We kind of came down. Possible indications, we don't know if we're going to get a close above the high of the low day here or not, like a hold, for example. I've been corrected by James Boyd. It is not a K hold, as I have said it, so I am pronouncing it correctly. It's a K hold, close above the high of the low day. And let's see. So there's your low day. We might get one here. That's a question mark. And some people might actually wait for that before they put on like a trade. But what we're looking at in this scenario, like with many bull flags, is just it's the potential for the follow through. We saw a higher high over this point. Now can we get a higher low? That's also a question. And the follow through here. And our idea here is, folks, is just to put the short strike somewhere in here that might be below the strike, below where the price of the stock is trading, giving it that flexibility of price action over the contract duration. I'm just going to estimate that over here as of the X date, the expiration date of that contract. Normally we're looking at, a lot of traders will look at 20 to 50 days for an expiration. That's just a key point. 20 to 50 days out in time to kind of try to balance out return and risk, over a time frame. Obviously, go out longer periods of time. You could bring in more premium, but there's obviously more risk as well. We want to lock into basically a price pattern time frame. And what I mean by that is, would we want to go out? I'll be real. I'll exaggerate massively here. Do we really want to go out a year on a small flag pattern, for example? Doesn't make a lot of sense, right? Maybe somewhere around a month's time frame. 30 days, I guess, or so. And that's right in the middle of our range. We could look at something like that, right? And so we're choosing, there's a lot that goes into this 20 to 50 days, but it could be, over longer periods of time you might be looking at as well. This could be a longer term flag pattern. You could go out further, but right now I just want to keep eyes on exactly what we're focused in on here, which is this time frame right here. So 20 to 50 days out in time. Any questions on that? Well, let me know. I'll keep an eye on the chat, I promise. A lot of times it's good for me in the chat to kind of be able to point things out visually for you guys, and so I'm happy to do that as well. Okay, so we looked at kind of time out into the future. What about, the deltas that we might be looking at? What level might we be selling at here as we're looking at strike prices? Well, a lot of times traders will use a delta of 20 to 40 to help them along those lines. Now, a quick note on the delta. The delta itself, as we look at it here in just a second on those options, it just says for every $1 increase in the underlying stock. So if the stock goes up $1, right? $1, that will move the option up by the amount, approximately the option range up by the amount of the delta. But that's what delta does. But traders will also use the delta as an estimate, a percentage estimate of the probability of the stock going down. So just an estimate. It's just hey, there's a 20% chance, for example. I don't want to say probability, but it's just 20% chance, let's say it goes below whatever strike price it is. So I want to look at that, but we're going to tie that into this for sure. But I wanted to also state, like over here, what's wrong with looking at support levels? Now, there was some prior highs right there. That puts us real close to about 73. Right there. So that's about 73-ish. I'm just eyeballing it between 72 and 74. There could be a potential level of support there. Support. Yeah, question mark. And what could that do? If we were selling a put below this level, well, there might be possibility of us bouncing off here and holding above that point and ultimately helping us to achieve our max gain at expiration by holding above that point. Because it can still go down too. Just one of the beauties of, you just have to love about a short put vertical or short puts in general is that it can go three directions. We can be wrong on it and still make our max gain. So let's go ahead and take a look at that right now and see where we're at. Since we are past earnings here, let's go into our trade tab and see what's going on and see where those deltas line up. Now you can see over here on the monthly contract. Now I've gone out, I don't think we have one. Yeah. So we've got to either use the 20-day, 22-day left, or the 50-day, maybe kind of the range we were talking about. We do have one right at the very far end, 50-day. Let's come ahead and take a look over here and see what we've got in terms of the delta. We're over here on the put side. If we look at the delta at a 72.50, how does that spread look? It's okay. I saw it a little bit better early on. It's about a 15-cent spread, between the two. We don't have a ton of open interest here, something to be very mindful of. We don't have a lot of open interest, but this stock regularly does trade above 1 million shares a day. It does have a beta of 1, even though it is a dividend aristocrat. And sometimes those dividend aristocrats are quite slow. They're kind of slow and steady, but some traders have been saying, and some market analysts have been saying that, maybe we're on the verge of a rotation into some of the income type stocks or value stocks. And then they start to look like growth stocks, which could set up an interesting scenario for this stock because it is an income stock. It could be a value type play. It's been down for a while. Okay, but it could take some time to get up there, but time's in our favor because when we're selling those options, the theta over here, that's paid out 7 days a week. Holidays, weekends, that's to our benefit if in fact, we are selling the option, which we are. Here's our delta, right, that we talked about that. So an estimate of a 32% chance, or an estimate that the price of the stock would go below that level. Now, what did we say as a support level? We said support could have been around, there could be support at 30, not 30, 73. Are we below that level? We are. So we may in fact have this support level working in our favor as well. Okay. All right. Paul does look at dividend growth stocks. Yeah, absolutely. Those that are growing. This is one of them that is, Paul. And you can find those stocks over here on the left-hand sidebar. I think many of you know this, but just in case you don't, we do have, basically, we have the dividend aristocrats here. It's 25 plus year dividend increases each and every year without missing a single year, and never a reduction to the dividends. Those companies are all right there. You're going to find Fastenal right there, right there. So I've been looking at a few of these because some of these stocks have been starting to move, and that does factor into our discussion a little bit today, Paul and everybody. In fact, this company over here, you guys have heard of it. Just as a quick note, AT&T has been showing some recent strength. Other companies, Kroger is one that we did, I think, we did a trade on in the swing trade class on Tuesday, but it's kind of falls. I don't know if it's a dividend aristocrat, but it's kind of like consumer staple along those lines, etc. All right. Well, those have been moving, and so they could be of interest, but we'll see if there's a rotation in here. Good news is we are giving it at a 72.50. If we sell that one, we might be below a little bit of support. There could be support along this level too, the prior lows on Fastenal. And from where we're at right now, let's look at it. To go all the way down to 72.50, right there, that is roughly really close. It's not exactly, it's about real close to a $2.50 pullback going against us, and we could still potentially be profitable. Now, a couple things to look at over here. If we just sell this, I mentioned to you guys, it's always fascinating just to look at the short put itself first. I'm going to try to go for just these are, looks like they're penny increment options. I'm going to try to go for a 130 as opposed to a 125. And if I just look at it, click on a confirm and send one time, you're going to see up top here that the margin requirement is a little bit high. Just making a short put comparison just by itself first. About $2,000, right? The margin requirement to put this trade on. Now, the credit over here is $130, the max gain, I should say, the max profit. The max loss does factor into the fact that of the assignment occurring. So if in fact there was an assignment that occurred, let's say, the price of the stock does go below that 72.50 by expiration, or after, before expiration, we get assigned 100 shares of stock, because one contract of a standard equity options contract is equivalent to 100 shares of stock. Well, what you're seeing right there in that max loss is just the representation of that stock going to zero, which could happen, but some traders don't think that that's very likely. But there you go. Just so you know, it could happen over 50 days. This stock's been around for a very long time, but I just wanted to give you the context of why that max loss is so high on a short put. Cool thing is we're talking about short put verticals. So this is where I think a huge advantage comes into play. I'm going to hold the control button on the keyboard, and I want to compare a couple of these for you. I want to look at a 2.5 wide as well as a 5 wide in here, and just looking at a few of them. So if we just did a 70 here, what does this do? So we're buying now the 70. We're buying the 70, and it's jacked up. I'll start over. We'll go ahead and click here and here. I start over. It's a 60-cent credit. So it's a lot less than we were just looking at it, like 130 roughly. And so that's there. Let's click on confirm and send, and let's just see what the differences are though. Okay, huge differences. Okay, we basically got this cut a little bit more than in half. from our $130 in terms of our max profit. Of course, I bumped that up a little bit. I'll say it was 125, so it's very, very close to halfway. If we were just looking at $1.25 for that original put, remember I bumped it up to 130. But it cut it approximately in half. Okay, 1/2 over here. We cut that down, our credit. But what did it do to our max loss? Folks, that max loss was like $7K. $7K. Now it's $190. Our margin requirement to put this trade on is $190. I believe this was very close to $2K. $2,000. What a huge difference for just taking half of the amount off. Huge difference. I mean, just, half the credit. But is there a way to get us close to almost a full credit here and maybe still keep our buying power effect, max loss, still reasonably low relative to just the short put itself? Well, it turns out there is. And I probably wouldn't have said it if there wasn't, to be honest with you, but we're going to go ahead and double it there. So we're going to try to double that credit. Now, this is per contract, 60. We got 2 contracts now. So now we should be close to 120, which was, before if it was just a single put, we'd be looking at about, this was like 125, right, for the same amount. Now we're at 120. But look what we've still been able to do. Max loss, far cry from the 7,000. Buying power, far cry from the 2,000. Right? It's a lot different. It's a lot smaller in terms of the max loss, etc. But we've almost, just by adding in 2 contracts, we've almost came right back up to where we were at. We're about $5 off our max profit. You see the advantage there of doing that? That's the advantage. Now, there are some individuals that just want to sell that put because it might be a way for them to try to buy more shares at a lower price too. Of course, you have to get assigned to do that. But if we're just looking for income, which is exactly what this class is about short verticals, those are substantial differences. As we go through there. In fact, I'm going to do this. Pull this guy up real quick. Let's go over here, and I'm just going to make some comparisons here for you. So it was 380. Not going to work. There we go. 380 divided by approximately 7,000. So it's about 5% of the total risk, a little bit more, if we're looking at it is where it stands right now. In terms of the max loss, in terms of the max loss relative to just the short put. I'm just doing percentage comparisons. Let's do this again. This is going to be a bigger percent, but still, we're going to use 2,000 here, about 19% relative to what it was before. But yet, where are we at here? I mean, we're so close. Well, okay, since I did all the comparisons, I might as well do it again. There we go, 120 divided by 125. But it's about 96% of the max profit. Yet we had substantial reductions, max loss, and the buying power effect. Just such a cool advantage there. So what we're going to do is we're going to go ahead and submit this trade in a second. What I want to do is make a quick comparison, though, by widening it out to a 5 wide as opposed to 2.5 wide. What are the differences here? Well, the credits are higher, okay? But if I click on the confirm and send up top, what do we get up top here? Well, we're at 90. We went with a 5 wide versus a 2 wide. 5 wide versus a 2 wide. Let me change colors here. And notice our credit is less than 120. Our buying power effect is greater than 380. In other words, our margin requirement costs us more with the single contract. And of course, our max loss is certainly greater than, well, the 380 over here. Now, it's obviously going to be better than the short put by itself, but the shorter distance between those strikes and just, making that tighter, what did that do? Well, it's still even an enhancement in terms of what we were looking. I'm sorry, this was a 2.5, not a 2 wide. It was a 2.5 wide spread. Let's make sure that's in there. Right, we just doubled the distance between the legs where we sold and where we bought at. But you can see right there by going with the 2.5, there are, some benefits to it. What is the downside? What is the downside? What do you guys think? The downside would be one of them. Oh, and there's a question coming into me. I'll tackle that one, Brent. But let me just explain this downside here real quick. Right over here, the downside is that we're buying one contract here. We're selling one. We're buying one on our 250 wide, $2.50 wide spread. We were doing 2 up top and 2 down below. So what does that do to our option commission? Well, it doubles the option commission. There still might be clear benefits that you see, but I just wanted to highlight the difference. There is, you are effectively doubling the commission. You've got 2 down on one side, you've got 4 on the other to make that comparison. There you go, Kevin. Thank you for making some points into the chat. Let's see. Bob says, Michael, I'd love to see you contrast between selling more contracts of a spread with closer strikes. Oh, I think we just did it, Bob. Was that the contrast? I think we just did that right here with the 5 and the 2.5. Oh, and Brent's got that one. Awesome. Okay. So I think we're going to go ahead and just go with the 2.5, and we're just going to increase the amount there. So exactly, Bob. That was part of our discussion today, but I think you just caught that. Maybe I didn't see your question as I was actually doing it. So let's just start over. We're going to do the 2.5, the shorter distance between there. We're going to ramp this up. Now, one thing I'll say is sometimes these options could be a dollar wide, and you have to add substantially more contracts, which could increase, the total commission. In this case, we're not quite that far. I mean, it was 2.5. I mean, 2.5 wide versus the 5 wide right there. Okay. Yeah. Fewer versus more. And that was exactly what we looked at here. We come back over here and we're still seeing those same contrast numbers. So this is the 2.5 versus the 5 that we just looked at there, Bob and everybody, and you can see the differences there. Substantial difference between the short put by itself, and even a noticeable difference between the 5 wide versus the 2.5 wide, this one here, for both the max loss and the max profit as well. There's the break even, so you see it. I think we're all set there. Yeah, but that's right. There could be, that was the other side of it. Yep, you've got to keep that in mind in terms of transaction costs. Now, would that be a ton more? Well, it doubles the cost of the transaction. You can think about it. Maybe it's whatever that might be, as you can look at it. But it's a good comparison to go through, and I think it's fun to kind of do from time to time as well. But that is our short put vertical that we've got here. I've got a couple more to do to take a look at. Where's that strike again? Let's just visually see it again one last time over here. Sorry if I'm being redundant but I wanted to just write it now since we've seen it. That was our short put right there. Looks like we got our fill up top, and then we went down to a 70. We did the 2.5 wide over here, the 2.5 wide between where we're selling and right here where we were buying that put. And again, part of that risk that we saw and wanted to kind of visually show is that if in fact the price of the stock were to have a substantial breakdown here, if we just had the short put alone, well, we've got basically 100 shares of stock at that 72.50. Now you always still get to keep the premium that you're receiving, that $125, but that could pale in comparison to a big decline down here too. So adding that long leg in there, hopefully we just visually saw those benefits to protect against a substantial, kind of like a fall out of bed type, reaction on the stock when you wake up in the mornings. Anybody done that? Looked at your phone and, all right, I have. So I'll state it for the record. I've been in those situations. It's not, it's just a nice benefit to have that. And so it gives you a sense of being able to sort of, be able to wrap your arms around that risk a little bit more instead of if there was a big gap down, shoot, I've got that long put to help protect me there. All right, next stock. This one was chosen very, very intentionally. It has a big gap, but it started to kind of creep back up here. You can see over here, one of the indicators that I use is a money flow. It kind of nets out, the indicator itself tries to net out buyers and sellers. It's been going up. Somebody's been buying it. They like these lower levels. Is there a value proposition down here? Remember, I mentioned earlier about income and value. Could there be value located down here? Why are people buying it? The other side is, well, this big gap that might make some people nervous. Maybe they're not expecting a really sharp rally to the upside. In fact, have we seen that? We really haven't. We've seen much, much more of a meandering move to the upside, haven't we? It's just very slow, it's steady, but that's okay because remember theta working for us. Theta is so nice because theta is really that time decay over time as tip, 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 dip, drips away 7 days a week. And if it's going slow and this trend is so mild to the upside as we're waiting, there's earnings down here, by the way, but as we're waiting and waiting and waiting, waiting, that is bringing in time decay. If it's slow, that can be something that could be considered here. So I threw that out there for a reason. This one, in other words, it may more fall into the category of a neutral as opposed to a bullish. It's kind of a blend. I have to say it's kind of a blend because the trend is up. Trend is up, and that was actually a little bit sharper move. So it's kind of maybe bullish and neutral slightly. Now there is an earnings announcement that could pose risk. I'm still going to throw this out here as a trade example for somebody that might be anticipating, maybe giving it a little bit more space. There's a lot of support down through here. We don't know what's going to happen, but if there was a big move, we're looking at it through the lens of somebody's okay with those earnings. Okay, you have to be okay with that because I'm going to choose a time frame that rolls through the earnings date where we can see volatility. We can see that, but keeping in mind that we do have that long put leg, and if prices do dive lower, well, we've got a way to, as we'll look in the dialog box here in just a second, to help maintain those risk levels, right? If we were to get a big drop. I drew this big red line in here too, because that's a lot of prior support. Now, will it hold? That's always going to be the question, but we just talked about it, and maybe selling a put below that level. I like to do this visually, and then I like to go back to the trade tab and take a look and say, okay, where are my deltas relative to support that I'm seeing on the chart? Because again, support, it may or may not hold up, but the nice thing is that this is a trend that's been going up. I know it's slow, I know it's moderate, but you could see still some indications of it holding support, and it would be kind of nice that if we were selling our puts below a support level. A lot of times you get those opportunities if you're looking at flag type patterns. We're still sticking with the flag pattern as the possible starting point of our move here. Now, let's go ahead and take a look at this and see where we're at over here. This has a lot more volatility. Any ideas why? It's those earnings, right? The earnings announcement. In fact, let's just pause and show you this. If we look at implied volatility on this, because implied volatility will tend to increase around big news events in anticipation of just more movement in the underlying stock. So IMPV is what it is. That's how they do it. You don't try to spell out implied, you'll never find it. But implied volatility, IMPV, is implied volatility. Let's go ahead and thicken this up a little bit so we can see it. We'll go dark green would be fine. There we go. We'll see this show up down below here. Boy, it hasn't gone up too much. In fact, it started to go down a little bit. I mean, look at that implied volatility here ahead of that earnings announcement. Wow. What a crush in implied volatility, which could totally work in somebody's favor, meaning that, the pricing of those options could drop dramatically because, remember, a 1% increase in implied volatility has this impact on the Vega. So 1% increase or decrease in implied volatility would drop or increase the option range over here by the amount of the Vega. So just showing that, but hey, we've already gone down, but we're not at these low levels that we've seen down here. I guess at one point we were down at about 30-ish. We've seen some lows here. We're about 20 points higher than that, or close to it, 49. Okay. Uh, you know what? We can just leave it on there. We'll just minimize it at the bottom. But that's an interesting one to watch ahead, and maybe you get a spike ahead of that announcement. It's just that we're kind of like in this little moderate flag pattern here. Perhaps. We'll see if it breaks out or not. Okay, back to the trade tab. We were looking at below 80 as a possible, oh, yeah, it was like right here. Actually, if I look at it, it's more like 82. I don't know if we have a strike at that level, but it was 80 is below the support level, and it also falls within the range that we talked about of the deltas that some traders will look at, which again is the 0.2 to 0.4. And that right there says some traders would estimate that there is 25% estimate of us going down below there by expiration. So all else equal, I mean, a lower delta could be construed as a positive from an investor perspective, if they're looking at that as an estimate, which is how traders oftentimes use that, right? So we've got support just above 80. We've got a pretty good spread in there. It's a 5-cent spread as it stands right now. That's amazing. We have over 1 million shares here. How are we doing over here on our 80 for open interest? Pretty good. We're in the thousands. A lot of traders to put on a trade might look for at least the hundreds, 3 digits. We're at 4 digits here. Okay, we do have only 5 wides here, but we are going at 50 days. Now, could we shrink that down if we wanted to a little bit? We don't have to necessarily choose a monthly. Bob and others were saying, hey, Mike, consider the shorter strike, which we looked at. But look over here. We have this opportunity now to go in and look at 43 days. And we have a lot more to look at here. We still have, look at this. So this is a 24 delta at our 80. Cool. Look at this. We have, how's the open interest? Not good. Spread. These are key considerations. Now, with a stock like this, although it is on the NASDAQ 100, it's a very well-known company. But as we look at it, those spreads are really quite bad. I mean, they're not good, and we don't have any open interest here. So that's the trade-off on a company like this. Now, you might not find that with an Amazon and some others, but we'll go ahead and take a look at this one here, but I'm just making sure. Yeah, see, look at this. This is a good sign that maybe the spreads are going to be a little bit wide, and by gosh, they are. Look at that, 170 to 215. That's kind of like, in a sense, sort of like a built-in loss. If we try to, we're just not getting as much when we initiate the trade. If we try to close the trade out early, which we can always, try to do as long as the option market's open. Well, there's another sort of built-in loss on the back end too, and that's not great. We don't want it. We don't want that. So for now, I'm just going to go to the monthly. I realize it's a 5 wide, and we'll look at it, and you can just kind of determine what we can see here. But here is just the 80 by itself, about 1,800. Just a short put. I've sold that put just as a short. Max loss about 7,700 and change. Just to give us a general idea, close to 1,900 actually here for a 230 credit. Let's just see if we can get a comparable credit, okay, with a substantially smaller max loss and margin requirement. So here we go. To do that, we're just going to simply go over here now and hold the control button down on the keyboard, click on the ask price, and boom. We lowered our credit, but we actually have to put almost 3 on here to get back close to our, oh, I'm sorry, not 3. It wasn't 3, it was 2. So, okay, we're not going to get quite there. We're about 230. This is going to get us to about 210. Yeah, 210 right here. But look at the differences. This was 19. This is substantially less than approximately 19K. And this is quite a bit less than approximately 7.7K. I realize we're taking a little bit off the top here. We're losing about, $20 from the credit, but look at those differences there. From 1.9, okay, yeah, 1,900 and change, roughly close to it. It was an approximate. This is about 7.7 thousand. Okay, so there you go. Let's go ahead and click on this and go send this on through. Okay, so we've got that through. Much, much better spreads in here, much better liquidity. In fact, both of these contracts, if we look at our open interest right there, existing contracts sitting out there, look at that, folks. That's a nice place to be, right? In terms of just open interest. We'll see how the trade unfolds, but my gosh, substantially better than those zeros all the way up and down the line on some of those weeklies there. Okay. Again, this stock does trade 1 million plus shares over here too. What is the theta looking like? Okay, there's some theta built in there. Again, it does have higher implied volatility too. A little bit more there. Be mindful of earnings coming up. Now, we're out of time here, but I did want to show you just a couple more charts that I'd like you to go through and take a look just for paper trade examples. Maybe some that have been showing some recent strength. I find these in the Tuesday class that I teach where we do swing trades. I basically spend my week looking for swing trade bull flags to go through there and look at. Now, this was a bull flag that actually did unfold for Amazon, and now it's simply just come back and tested the prior high. Now, the question is, will it hold here? We do have earnings, but there could be a larger flag pattern in play up to a target 2 level, T2. This is the T1, back to the prior high. This is a swing trade concept that we use for flag patterns. That's a T2. There's still some room over here for a T2 rally if it bounces on up. Could be interesting to take a look at. I want you guys to see it. Let's see. Apple was one that began to bounce kind of sharply, broke through a trend line there. Gosh, it does have earnings coming up real quick as well. We had PayPal in here, kind of sideways, but that's sort of a little. You see it? The little bit of a minor bull flag right there. We're just creeping out of it. That one too. Okay, so I gave you 3 additional ones to just kind of look at if you want to do some paper trades on here, folks. Hope you liked today's presentation. That was always the goal of filling in for Connie today. I talk about these in that class on Tuesday, and be sure to take a look at Brent's classes. I help Brent with in chat a class that he does on options that are tied right into this class in terms of managing an options portfolio. He does a great job on that. I encourage you to take a look at Brent's stuff as well, folks. But just kind of wrapping up here, really easy to do. Hit that subscribe button if you're not already subscribed to our channel, bottom right hand corner of the screen. And with that, yeah, be sure, if you did like today's presentation, smash that like button. It lets me know that it was useful to you. I don't think we saw a survey there, but it does help, keep that YouTube algorithm content kind of coming up more frequently. By the way, there was a question in here that just said, hey, Frankie, why not look at the 21? Yeah, Feb 21, we could. We're kind of running out of time. I wanted to show you these other ones here, but absolutely, you got the right idea. And that's exactly what I want you to be thinking about. Why not the 21 monthly, which is, I think you were talking about over here. Why not do that? You could do something like that right there. Yeah, for sure. We were just kind of looking at a little bit longer term, and look at this. Not quite the open interest you're getting in the thousands, but you're still getting much better than the weeklies and pretty decent spreads. So take a look at that one. It's kind of a little bit of side work here. You could take a look at. Do some examinations there. All right, everybody. Well, good to be with you. Look forward to future discussions. Connie will be back next week. Have a great rest of the day. Bye-bye.